Today, the support spider grows. DFA Daily to the 2nd of April 2020. Hello again, it's Martin North from Digital Finance Analytics, one that I just post covering finance and problem news with a distinctively Australian flavour. Prime Minister Scott Morrison has announced that free childcare will be offered to nurses, doctors, hospital cleaners and any worker who still has a job amid current lockdowns for 6 months after new healthcare crisis childcare reforms. Care will be free from Sunday night, April the 5th, and offered to essential workers regardless of their family income. We will be ensuring for those parents who are still in that position where they're needing that childcare, it will be free, he said. We'll be putting in place support arrangements to the childcare facilities, some 13,000 of them, to ensure they remain open and be there for their parents to ensure they can do what they need to do each day. Under the $1.6 billion bailout for the sector, the Morrison government will also guarantee a portion of childcare subsidies that would otherwise have flowed before parents started withdrawing their children. The way it will work is that we will look at what 50% of the fees up to the rate cap were in the fortnight before the 2nd of March, and we will pay you that amount on a fortnightly basis, he said. Now, there are some conditions that we're asking. If the sector are to receive these payments, the centre must remain open. It must provide care for those parents who need their children cared for. They must also seek to re-enrol those parents who might have dropped off. So another leg of the ever-growing support spider just sprouted. And yesterday, the RBA released their minutes from their emergency meeting held on the 18th of March. The board agreed, it said, on a package of measures comprising, namely, a reduction in the cash rate to 0.25%, a target of 0.25% for the yield on 3-year Australian government bonds, a term funding facility to support credit to businesses, particularly small and medium-sized businesses, and an adjustment to the interest rate to be 10 basis points on balances held by financial institutions at the bank. Now, what is clear is that the impact of the health issue is likely to stretch beyond June, they said. But the RBA also said it has no appetite for certain unconventional policy measures. And while the immediate outlook is highly uncertain, the RBA still believes that Australia will experience, quote, a very sharp contraction in economic activity. While it is not possible to provide an updated set of forecasts for the economy, given the fluidity of the situation, it was likely that Australia would experience a very material contraction in economic activity, which would spread across the March and June quarters and potentially longer. And at that meeting, of course, the RBA made the historic decision to deploy Australia's first quantitative easing campaign, setting a target for the yield on 3-year Australian government bonds of 0.25%. In considering the overall package of measures that had been discussed, members acknowledged that the term funding scheme and the 3-year bond yield target were both significant policy developments that would not have been under consideration in normal times, the board wrote. Nevertheless, members strongly supported the proposed policy response as a comprehensive package to complement the fiscal response announced by governments in Australia in the preceding week or so. And the RBA also continued its campaign of interest rate cuts, slashing rates to 0.25%. But it is likely that 0.25% is as low as the RBA will go. Members also agreed that the cash rate was now at its effective lower bound, the board wrote in its minutes. Members had no appetite for negative interest rates in Australia. And the RBA sought to emphasise that the bank expected a recovery once the outbreak is contained, supported by the low costs of funding across the economy. Well, we'll see about that. And UBS discussed the potential trajectory of home prices. Looking forward, they expect existing home sale volumes will collapse, likely more than halving near term, as long as the ban on auctions and open home inspections remains, which seems likely to persist for months. They also revised their forecast for home prices to start falling, given the hit in demand from the looming sharp recession and the spike in unemployment. They said that the extent and duration of price falls is very uncertain, but lenders offering deferred mortgage repayments for 6 months is critical in helping to minimise forced selling. Furthermore, if price falls do become very significant and potentially a macro stability risk, they would expect further material government support. The potential policy options include expanding or extending the first home buyer scheme to help overcome the deposit gap, cash payments for home purchases, for example, the Home Owners Grant, albeit they think that it should be for new homes only, temporary reductions in state government charges, especially stamp duty and land tax, or support to create a build-to-rent industry. But they said it depends more on government policy than anything else, so there's no free market here. And CoreLogic released their final auction stats from last weekend. The weighted final clearance rate was just 37.3%, or 1,063 cleared auctions on 3,289 listed, which was as low as it has been. Canberra reported 45%, Sydney 40.3%, Melbourne 37.6%, and Perth 33.1%, all higher than Brisbane and Adelaide, which were at 22%. If you wanted more indications of price falls ahead, this is it. And the long-term trend speaks volumes, as their summary chart indicates, to levels below those back in 2012. The property market is stalling, have no doubt, despite the fact that at the moment it appears listings are rising as people attempt to take to the exits. That could get very interesting. And the ABC's Stephen Long published an article, Analysts believe banks can withstand the shock, but high debt levels leave few buffers. Analyst Brian Johnson sees a few reasons to be cheerful now despite the dire economic shock. Firstly, whether by design or a fluke of fortune, the Australian banks cashed up in January and February. The costs of funding for the Australian banks had gone down, and the Australian banks exploited that. Johnson said, "At the time I was puzzled, but they actually raised a lot more funding than they would normally require. Why? Luck is his conclusion, though maybe the banks saw it coming." Either way, it means major banks here secured a lot of cash before wholesale funding markets all but froze in response to the economic fallout. It will be 6 months before they need to tap the markets for funds again. And then, of course, the RBA stands ready to assist if banks are low on cash. Since 2015, in the wake of the global financial crisis, the RBA has offered some Australian banks what is known as the Committed Liquidity Facility. In the RBA's own words, it entails the central banks committing to stand ready to provide a bank with liquidity against high-quality collateral that would otherwise be illiquid in the market. In other words, in times of distress, banks can bundle up loans into securities and park them with the central bank for a very modest fee in return for cash. This emergency line of credit is set at more than $220 billion this year, and if that's not enough, the RBA would likely scale it up or set up something else if necessary. And the central bank is also offering term fundings of at least $90 billion to the banking system to allow lenders to support small and medium-sized businesses, but it will also allow lenders to shore up cheap reserves. Some 130 banks, building societies and credit unions can borrow from the RBA dirt cheap at a fixed rate of 0.25% for funds equivalent to up to 3% of their total outstanding credits to households and businesses in the first instance. It's not free money, but it's close to it, Mr. Johnson said. And since the global financial crisis, the federal government has also guaranteed bank deposits up to $250,000, meaning the vast majority of people's savings are protected, obviously, if that scheme is activated. In the wake of the global financial crisis, regulators required the banks to lessen their reliance on short-term funding. that had to be rolled over relatively quickly and secure more long-term funding in an effort to make the banking system, in the regulator's words, unquestionably strong. Measures to reduce risks in banking systems are being mirrored around the world as the states step in to protect financial institutions after learning lessons from the global financial crisis. What we can see around the world is the transfer of risk from the private banking system to the public sector, Mr. Johnson said. The upshot is that the banks come through this not in great shape, but in a better position than some of their share prices would indicate. The transfer of risk from profit-seeking banks to the public sector, though, raises some interesting philosophical and moral questions. Profit is often viewed and defended as a reward for risk-taking. However, if and when push comes to shove, the institutions of the state are going to take on the bank's risks in order to safeguard the economy, then how much profit is justified? And what should the state demand in return? Now, those are extremely good questions. And economist Gerald Minnock agrees that the banks will be safe because the government won't let them fail. It's a huge impact on the profitability of some of the lines of business, Mr. Minnock said, but ultimately the authorities and the RBA will backstop them. So we will have banks. They're not going to go out of business. Now, there are, though, some caveats to this relative optimism, however. One is the unknown duration of the crisis. If it lasts 6 months, I think we muddle through, Mr. Johnson said. But if it goes much longer, well, then expect Morrison and Frydenberg to step up to the dais again and pledge more money. We will see depression-like economic data in the next 3 to 4 months, Mr. Minnock said. The difference is that in the actual Great Depression, government policy actually exacerbated the downturn. Their response to the initial shock was to tighten fiscal policy, tighten the budget. Whereas now, of course, we've got massive loosening of both monetary and fiscal policy, with policymakers acting in a proactive way. However, it is possible the economic and financial impact will be so enormous that it will overwhelm the fiscal and monetary policy response. One of the things the global financial crisis demonstrated was the multiple feedback loops that happen in an interconnected global financial system, where all manner of bills and payments are packaged up, traded and sold throughout the world. High levels of defaults could feed back into the financial system, causing potential chaos. And Graham Anderson from Mortgage Analytics believes the government and central bank may have to step in to bail out the banks if the economic shock continues to October or beyond. Extreme levels of household debt also mean we come to the crisis with few buffers, Mr. Minnock argued. While the major banks are offering a 3 to 6 month grace period where customers can freeze payments on their mortgages, there are no guarantees banks will be willing or able to extend that if the crisis lingers on. We are going through a period where they will offer some forbearance to their borrowers, but it's all contingent on how long this goes on for and how generous they are, Mr. Minnock said. It's one thing to go easy on owner-occupiers, but the classic nurse or teacher with 4 or 5 investment properties we hear about, how long will the bank go easy on them? We don't want to reward the imprudent. There are a lot of examples around the world, in Australia, where people have absolutely pushed and overextended themselves in the belief that nothing will ever go wrong. This is obviously a huge sideswipe that no one could have foreseen, but ultimately shows that you need some buffers in the system, and we've taken out most of the buffers. And Mr. Minnock also said a sharp decline in home prices could create a powerful wealth effect, which may discourage people from spending even after the immediate economic shock passes. We've got virtually no household savings. We all felt like we could save less because our houses were doing the saving for us, he said. If we then see consumers start to rebuild their savings rates, then that could become an extended drag on the economy for some time. Or perhaps, freed from the confines of social distancing and shutdowns, we will eat, drink, and be merry. We shall see. And over in New Zealand, the Reserve Bank over there is introducing a term lending facility, a TLF. That's a new longer-term funding scheme for the banking system in support of the government's Business Finance Guarantee Scheme to help promote lending to businesses. The TLF is similar to the recently announced term auction facility, the TAF, and both provide liquidity to the banking system. The TLF aims to complement the government's Business Finance Guarantee Scheme, which was announced last week, by ensuring access to funding for banks at low interest rates for up to 3 years duration, which is longer than the bank's other liquidity facilities. We are working in step with the government and the country's banks to provide the economic support that is crucially needed during this uncertain time, the Reserve Bank Governor Adrian Orr said. New Zealand's financial system remains sound with strong capital and liquidity buffers. We are confident that the financial system is well placed to respond to the impacts of the health crisis. The facility is designed to support bank lending under the Business Finance Guarantee Scheme. Assistant Governor and General Manager of Economics, Financial Markets and Banking, Christian Hawkesby, said. We are currently engaging with the banks on the operational deals of the scheme, with the intention of launching our first TLF operation in May. And as previously announced, the Reserve Bank's Monetary Policy Committee has worked to mitigate the severe economic effects of the crisis by reducing the official cash rate and implementing a large-scale asset purchase program. In addition, the Reserve Bank has deferred the start of increased capital requirements and is delaying planned regulatory initiatives to allow banks to focus on lending to their clients during the current disruption. To further support the stability of the financial system during this period of economic uncertainty, we have agreed with the banks that during this period there will be no payment of dividends on ordinary shares and that they should not redeem non-CET1 capital instruments, Deputy Governor and General Manager of Financial Stability Jeff Baskad says. The restrictions take effect from today under revised conditions of registration issued to all locally incorporated banks, and they will remain in place until further notice, with the aim of relaxing them when the economic outlook has sufficiently recovered. This initiative further supports the stability of the financial systems by maintaining higher levels of capital during the period of falling economic activity resulting from the current crisis, Mr. Baskard said. And given the wholly owned subsidiaries of the Australian major banks in New Zealand account for around 85% of New Zealand's banking assets, the inability to pay dividends has potential impacts on the Australian parents. And as we've discussed in some of our previous posts, other jurisdictions are also placing restrictions on the ability of companies to pay dividends in the current crisis, which begs the question, could it happen in Australia? Places like Canada are not planning to suspend dividends. And CBA's first half dividend was payable on the 31st of March this year. So if regulators were going to act, we think they would have done so before this money was paid to shareholders. And of course, many individual investors hold bank shares for their dividends, so enforcing dividend cuts will result in yet more cuts to household income, so potentially a further need for the government to increase welfare payments. Now, we know, of course, that bank profits and dividends were already under pressure before the current crisis, so this is one to watch. And another support spider came from the US, with the Fed's support being deployed to ease the strains on the Treasury market resulting from the health crisis and increase banking organisations' ability to provide credit to households and businesses. So the Federal Reserve Board on Wednesday announced a temporary change to its supplementary leverage ratio rule. The change would exclude US Treasury securities and deposits at Federal Reserve banks from the calculation of the rule for holding companies and will be in effect until March the 31st, 2021. Liquidity conditions in Treasury markets have deteriorated rapidly, they said, and financial institutions are receiving significant inflows of customer deposits, along with increased reserve levels. The regulatory restrictions that accompany this balance sheet growth may constrain the firm's ability to continue to serve as financial intermediaries and to provide credit to households and businesses. The change to the supplementary leverage ratio will mitigate the effects of those restrictions and better enable firms to support the economy. As the board has previously stated, financial institutions have more than double their capital and liquidity levels over the past decade and are encouraged to use that strength to support households and businesses. The board is providing the temporary exclusion in the interim final rule to allow banking organisations to expand their balance sheets as appropriate to continue to serve as financial intermediaries rather than allowing banking organisations to increase capital distributions, and will administer the interim final rule accordingly. The supplementary leverage ratio generally applies to financial institutions with more than $250 billion in total consolidated assets, and it requires them to hold a minimum ratio of 3% measured against their total leverage exposure, with more stringent requirements for the largest and most systemic financial institutions. The change would decrease temporarily Tier 1 capital requirements of holding companies by about 2%, and in aggregate the change will be effective immediately, and the public comment period will be 45 days after that. And finally, President Donald Trump has called for another $2 trillion worth of stimulus just days after a controversial hedge fund manager urged him to spend big on infrastructure. While Washington already unleashed more than $2 trillion in fiscal stimulus, including in checks of more than $1,000 to Americans who are out of work, President Donald Trump wants more. With interest rates for the United States being at zero, this is the time to do our decades-long awaited infrastructure bill, President Trump tweeted. It should be very big and bold, $2 trillion, and be focused solely on jobs and rebuilding the once great infrastructure of our country. The tweet comes just days after controversial hedge fund manager Bill Ackman urged President Trump to launch that initiative. Mr. President, why don't you launch the biggest infrastructure program of all time now? Roads, bridges, and other infrastructure involve outdoor work that allows for social distancing. Doing so will put Americans back to work now in good paying jobs. Now let's just be clear about all this. Governments around the world and central banks around the world are dipping into the future to prop up the present, with more support across more dimensions, in a bid to keep an economy floating. And if you are in the MMT camp, then this really is no issue, and they say we can go on as long as you want. However, others might be concerned about mortgaging the future. It comes to the knotty question of whether in fact public debt ever needs to be repaid. And now turning to the markets, the Australian market had a down day today. The ASX 200 was down 1.98% to 5,154. The financials index was down 4.21% to 4,188. And the real estate trusts were down 3.4% to 1,038. The volatility index was up 5.76% to 4311. And the S&P 200 futures was up 1.99% to 5,157, signalling maybe a little optimism ahead. ANZ was down 5.03% to 1623. CBA was down 1.47% to 6161. NAB was down 3.6% to 1607, and Westpac was down 3.89% to 1604. Peter King has been confirmed as the new CEO. Bank of Queensland was down 1.77% to 4.99. Bendigo and Adelaide Bank was down 1.4% to 636, and Suncorp was down 4.35% to 902. Macquarie Group was down 0.53% to 88.25. AMP was down 5.67% to 1.33. And Genworth was down 3.83% to 201. McGrath was at 19 cents. And Yellow Brick Road was down 3.57% to 5.4 cents. AFG was down 4.44% to 129. Mortgage Choice was down 3.05% to 6. Mortgage Choice was down 3.05% to 0.635, and CIMAC was down 1.48% to 23.25. The Aussie dollar was up 0.38% to 60.93, And the euro Aussie dollar was down 0.71% to 1.7925. The 2-year bond was down 3.38% to 0.229, and the 10-year bond was down 2.59% to 0.77. The Aussie Gold Cross was down 0.77% to 2,610, and the Bitcoin Aussie Cross was up 4.5% to 10,947. And in New York last night, the Dow Jones was down 4.44% to 2943. The S&P 500 was down 4.41% to 2,470. And the Financial Services Index was down 5.97% to 246. The Volatility Index was down 7.57% to 5274. And gold was up 0.85% to 1,605. While WTI oil was up 7.63% to 21.86. And the Nasdaq was down 4.41% to 7,360. And looking ahead, the S&P 500 futures is up 2.05% to 2,498, while the Nasdaq futures was up 1.95% to 7,583. And so to conclude, given all of the money flowing from governments into supporting the financial system and beyond, and the central bankers and their activities, the markets are uncertain about whether prices are cheap or expensive. And this is a sign, I think, of more bear market conditions ahead. There will be the occasional up day, but frankly, until things are much clearer with regard to the health crisis, all the rest, frankly, is just noise and turmoil. But reflecting again on what I said at the start, we are seeing the tentacles of the state reaching further and further into the financial system and beyond, supporting households, supporting businesses, supporting banks. And this could be one of the biggest transformations of economies around the world for a generation and beyond. But I'm concerned that we're not understanding the full consequences and implications of all that's being done in our name. And as a taxpayer, I'm concerned about what that means down the track, because I still think somebody somewhere is going to have to pay it back. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.